morning and welcome to our first video blog. I'm going to talk a little bit about how we see the market environment at the moment, and maybe to start with, just to give you a little bit of background to how we've seen things over the past few years. As you know, we worked very hard in 2008 to protect capital, and we did that by both the combination of raising cash and by trying to invest with those companies which had, even in a recessionary, difficult economic environment, which had the clearest and most visible outlook. And we also made sure that we had very few companies, or companies with as little leverage as possible within our various portfolios. And then if we go forward to the beginning of 2009, we became much more aggressively invested, and perhaps a little bit early. But first of all, we were encouraged by strong signs of recovery across all economies, coupled with companies who are implementing extremely aggressive cost-cutting programs. And also we saw companies working very hard to reduce their balance sheet debt. And this, of course, as you can imagine, the bottom of the market was coupled with very enticing, very low valuations. And as you know, we then had a very powerful rally in 2009. So where are we now in 2010? We're still very positive, and I think the key is that companies, we think, should be able to generate much stronger earnings than many expect. It's interesting how this time around companies have responded to the crisis by cutting costs both very aggressively but also much more quickly than we've seen in previous downturns. And it's come at the same time where demand really has been surprisingly strong, particularly in the emerging world, but also in Western European economies. And although the data looks a little bit fragile in the Western world at the moment, all the indicators that we look at and our conversations with companies point to really very strong recovery in the following months. It's also worth saying the macroeconomic environment has been extremely supportive. Credit is now much more readily available, particularly for larger companies. Rates, as we all know, remain at breathtakingly low levels. And also, finally, very importantly, is a number of significant government stimulus programs worldwide, which we think will help boost economies. And most notably, of course, what the Chinese and US governments have done. I think another point which is worth noting is that our traditional investor base is very cautious. Insurance companies, as we know, have as lower exposure to equities as we've ever seen. And also anecdotally, most of our investors we come across have a very negative attitude towards equities and tend to be much more than normal invested in government bonds and corporate bonds. I think the final thing to say on the positive side is that European shares, despite the rally, to us appear in very good earnings. Share prices have gone up a lot, but so have earnings for the market as a whole. And we still see the market trading on some 11-time trend earnings, which, as many know, is at a very strong discount to the US, as large discounts as we've seen ever. And of course, compared to bonds and cash, equities have never looked so cheap. The major negatives remain what might happen when quantitative easing is reversed. It's arguable that how much of a benefit quantitative easing has had, but it's something we have to have a very close eye on. But we feel will become more of an issue further out. And the other question, of course, combined with that is how major Western European countries rebalance their debt. But again, whilst the numbers are very large, we think is something which should be manageable with a combination of tax increases and reduction of public spending, and we think economic growth should be possible despite this. So finally, just to look at the shape of the funds, we still have quite a cyclical and financial orientation. We believe that the recovery hasn't been properly and fully discounted yet, but also it's fair to say we've marginally changed the shape of the funds in the last few months, in that we've become less exposed perhaps to some of our more aggressive recovery situations where the valuations are now looking more full. And at the same time, we've been able to find an increasing number of very high quality growth companies whose valuations and share prices have been eclipsed by what's happened in the more aggressive areas of the market.